All right. Welcome everyone to our first time Homebuyers event and happy hour. I'm so glad you came out, especially tonight. I know the weather's getting a little slippery out there, so we really appreciate it. First thing I want to do is make some introductions. And this is our team of agents here at Truen Group. We're brokered by eXp Realty. I'm Laurie Dick, if I haven't met you yet. And also is Stephanie Reinick. Stephanie is somewhere warm, so we're not even going to talk about her right now. But she's another experienced agent. Stephanie and I and Chantel are licensed in Minnesota and Wisconsin. Next up is Jacob. That is actually my son. He is licensed in Minnesota. He is doing investment real estate, house hacking. We'll talk about that in a minute. Chantel 𝗧𝗶𝗺𝗃, who is an agent again, licensed on both sides of the river here. And then we have Connie Paulson and Sherry Hoppy. And they joined us like a few months ago. Sherry's actually taking her test, or not. Just got done with classes literally like an hour ago for Wisconsin. When it comes to first-time home buyers, we're an extremely experienced team, just so you know that. Stephanie and I have helped a lot of clients in their first-time home purchase. It's some of our favorite clients. They continue to be our clients as they move up or start investing. And then we have Jacob. I said he's house hacking. For those of you who maybe need cheaters, house hacking is when you buy a house and yet you rent part of it out. So you're kind of offsetting those expenses. He actually bought a duplex in Minneapolis, rehabbed one half, renting out the other half. He's going to do that, and then he's going to buy another one. I don't know what his plans are. Chantel, she started out as my client a few years ago, and yay, now she's part of our team. And she has renovated, or her and her husband are renovating pretty much the whole like kitchen, living room. You've done a bunch of stuff on their house since they purchased it. She has a great eye for that stuff. She's very knowledgeable in knowing what is possible and not possible when you're buying your first home and as you're like expanding or improving it. And then Connie and Sherry, as they joined us, Connie's son is here. They have their kids are at that age, so they know that group, that those millennials who are coming up, I don't even know what, and Gen Zs are actually getting into home buying now. So they have their finger on the pulse. They know what they're doing. Even though their license seems new, they also have the backing of our entire team. And so by way of that, we are an exceptional team, but we're only exceptional or partly exceptional, or however you want to say that, because we have these amazing women who are supporting us. We have Tammy Freeman, who has been our my admin since 2017. And when I was a solo agent and thought I just can't do this on my own, and she stepped up, pardon my language, to help me keep my shit together. So, and she continues to do that to this day, but now on a bigger scale for our whole team. And then Jessica, who couldn't be here tonight, she is our transaction coordinator. So once you purchase a home and you have a contract all the way to close, she follows that paper trail down. And then Katie, who is here, who is our phenomenal marketing coordinator and does everything from what you see on social media to our marketing for our clients' homes and 100 other things. We're extremely, extremely careful about who we put in front of our clients because they're our number one concern. And that doesn't mean just plumbers and painters. Even more important is when we talk about your finances. And so we are very fortunate to have Dave Craig as our lending partner. He has helped me and my husband with our mortgage, with our refinancing. He has been Jacob's loan officer, Chantel's loan officer. We refer him to everyone because he is so professional. He answers the phone when he calls them. He goes to bat for our clients, which is really important in this market. And so I can't say enough good things. We have become really good friends over the years.
Yeah,
right?
yeah.
And that just, so before he comes up, because he has a lot of information to give you, I'm going to say some things you may or may not already know, and that's why you should buy instead of rent. Some of you are house sharing, some of you are renting right now. One of the things is the average rent increase in the last year was 11%. That's insane. 11%, the typical is 3 to 4%. So think about that. If you were, and those increases are across the board, condos, townhomes, single family homes, right? Single family homes alone is 26% increase. If you're paying $1,000 in rent in 2020, in 2021, that same house, you're gonna pay $260 more per month. That's insane because the rate or rentals are 100% interest and 0 equity. So when you're thinking about, I hear that interest rates are going up, what's more than 100%? There isn't anything. So you're paying the highest interest rate you can right now. This guy has no money in his wallet because he gave it all to his landlord. So when we talk about home buying, the national average home appreciation, national coast to coast, was over 18%. This is from Q3 in 2020 to 2021, so 18%. But if we talk about Minnesota, it's over 14. And Wisconsin, yay Wisconsin, they're almost 16% appreciation across the board. What does that mean? If you purchased a home a year ago for $250,000, over the course of the last year, you gained over $35,000 in equity. This guy, he's putting money in his wallet because that's equity that he's earned by just maintaining his home. The other big question we get is, what about inflation? This is from a few different sources they put together, over 60 years of data that shows that home appreciation outpaces inflation. So if you think, yeah, but I'm gonna be paying more for gas, I'm gonna be paying more for toilet paper, you're also gonna pay more for rent. If you're a homeowner, your appreciation is going up and your equity is in your home. It's always a safe bet. So, now, how are you gonna pay for this home? What do you need for a down payment? What do you need for a credit score? And that's where Dave's gonna come up.
All right. So I'm gonna go through a couple different programs that are out there in Minnesota and Wisconsin in regards to first-time home buyers, or not necessarily a first-time home buyer, but has down payment assistance options tied to it. And then, like Laurie said, as I go through this, if you have questions, it's best to ask them as we're on the slide and not try to have to remember them to the end. So we're going to start with Minnesota, the Minnesota programs. So the Minnesota program is the Minnesota Housing Finance Agency. It's a state-run organization that offers down payment assistance for home buyers who are qualified home buyers who are looking to buy in the state of Minnesota. So they have 2 programs. One of them's called the Startup Program, and then the other one's called Step Up. So we're going to start with the Startup Program. So the Startup Program is for first-time home buyers. And the first-time home buyer is defined as someone who hasn't owned a home in the last 3 years. So, you know, if you did own a home in the past, but it's been 3 years since you have, you can actually qualify for these programs. Now, as of today, they have, these are the sale price limits. So you can't buy a house over these limits currently in the area. So the 11 county metro area is obviously a little bit higher than the balance of the state. So on the Startup Program, they have 2 what they call deferred payment option loans. What that means is there's no payment, no interest on the loan they give you. So basically when you take it out, they give you a certain amount, it stays on that house until you sell it. So when you sell it, then you have to pay that loan back. That's when you pay it back. So the first one, you can get up to $11,000 in down payment assistance. And like I said, with no payments and no interest, and that money can go towards your down payment and your closing cost. The second option, you can get up to $15,000 in down payment assistance. And again, goes towards your closing costs and your down payment. But you have to meet 2 of the following requirements. So if you have a household of 4 or more living in the household, one of the members has a disability, a borrower is a single head of household, so like a single parent, and then the mortgage payment is 28% of your gross income or more. Most everybody meets that last one, so you really just have to, in most cases, just meet the other 3, one of the other 3. So that's kind of a nice bump of an extra $4,000 for like a single parent. As I mentioned, there's income limits, and this is probably the most detailed or complicated graph of all the programs, because they break it off by the household size and then where you're buying. Not really sure why they break off the metro area and then Dodge and Homestead is Rochester, basically. They're the same income limits and they're a higher amount. And then if you go outside the state, then you have these income limits you have to meet. So those are the income limits you have to meet to get the deferred payment option, right? So the other one they have, the other program is called Step Up. So on Step Up, you don't have to be a first-time home buyer. You can be a first-time home buyer and use it, and I'll explain why that comes to play sometimes. And so because you don't have to be a first-time home buyer and you're moving up maybe to a different house, it has a higher sale price and income limit, and it has a down payment assistance that has a monthly payment tied to it. This again also has sale price limits on it. So what it shows is they break it out on this one as compared to the one before between a single family home and a duplex. So you can actually buy a duplex under this program. And as you can see, the limits are quite a bit higher on this than they are on the other one. So that might be one reason there why you would take this program versus the Step Up program if you're a first time home buyer, if you're looking to buy in that area or that range. And then the income limits are higher too. So the 1 to 2 person household on the other one had to make less than $76,000 to qualify. But on this one, you can make up to $156,800. Again, in Twin Cities and Rochester, and then outstate is $139,200 too. So it gives you a lot more leeway. So what's the difference? The difference is that you can get up to $17,000 in down payment assistance, but there'll be an interest rate and a payment on it. So the interest rate is the same rate as your first mortgage. Okay, so whatever rate we lock you in for the first mortgage, you get for the second. And that's a pretty good deal because typically second mortgages rates are higher. So if I lock someone at 3 3/4 and they take a second through a bank, they're probably paying 4 3/4 on the second. Whereas this one, they give you the same rate for both. And it's based off of a 10-year amortization. So the payment or the loan will be paid off completely in 10 years. So you might take out a 30-year fixed on the first one, that's a 30-year loan, but this one will be paid off in 10. So I have some examples because the payment's not too bad. If you took out the whole $17,000, your payment's about $170 a month. And $16,000 is about $116, $15, $150, and so on down the line. So you can take any increment in $100 of what you think you need in that respect. So you don't have to take the whole $17,000. And I typically, if you don't need it, I try to minimize that as much. I mean, the lower we can make that, the better it is for you. So an MHFA recap, if you qualify for a loan and are eligible for MHFA, one requirement they have is you have to contribute at least $1,000 of your own money to the transaction. And the rest can come from that down payment assistance. And sometimes that works and sometimes it doesn't. So the higher the sale price, the harder it is to get the down payment assistance and get you down to $1,000, but it can minimize you pretty good. And then you have options, in this case, of course, the down payment and closing cost assistance programs. There's a for first-time home buyers, you have to take a first-time home buyer course. And this is the website for it. It's an online course. It's not too difficult. They tell you it's an 8-hour course, but people do it in an hour or two. And it's one of those courses you can go on to start and come back and do it. It's a great program. It's a good course to go through and just check it out, even if you're not ready to buy right now. And then there's different types of loans they do under MHFA. So even though it's a down payment assistance program that they're giving through the state, you can do a conventional, an FHA, a VA, or a rural development loan. And we'll go through that a little bit more, the rural development loan at the end. So the conventional, the minimum down is 3% down. You can go with that option. FHA is 3.5% down. Most people, we try to go conventional first because writing an offer on an FHA deal right now is pretty tough. But there's cases where you have to go FHA, and then that's kind of where you are with that. And then, of course, a veteran can do it with their 0 down.
Question on that one. Can you
Yep.
explain the differences between the types of loans we have up there?
Yeah.
Just what each type is?
So a conventional loan is, you ever heard of Fannie Mae and Freddie Mac
Yeah.
in the news? That's who they are.
Okay.
So they back all the conventional loans. They have cheaper mortgage insurance on them, and they also have the option that when you reach the 20% equity in the house, you can get rid of that mortgage insurance.
Okay.
So in a comparison of that, when you think about FHA, that's probably the next most popular one. They're 3.5% down, so a little bit more. Their mortgage insurance is more. So they have an upfront fee they charge you, which they add on to your loan, and they charge you per month. Whereas conventional just charges you a per month fee, which is typically cheaper. One difference on the mortgage insurance with conventionals, they'll base it off your credit score, whereas FHA just has a flat amount. And then the VA, you have to be a veteran. So they'll get an eligibility to do a zero down program.
Okay.
That one has like what they call a funding fee. And then the rural development loan, I'm gonna go through that more in the end because I have a slide about that, but that's homes that are outside the metro area. But the thing is Wisconsin qualifies under rural development right here on this western side, most of it except for parts of Hudson. So that's why that's a good program in regards to.
Dave, I'm gonna interrupt for a quick question. When he said it's hard to get an FHA accepted right now, part of that is because of the appraisal issues. So let's say Stillwater, we have an older home, you know it's older, it's probably got lead base somewhere. Don't lick the windowsills, so whatever. But FHA, if it's flaking at all, they're gonna make you remove it and repaint it by someone who's licensed to remove lead paint. Well, no seller wants to deal with that. So if you have the same offer, everything else is the same, but you have conventional, and they don't care. They just don't.
They don't.
They figure you know what you're doing, they don't care. We'll take conventional over FHA as a listing agent any day.
Yep.
So that's a big deal.
Yep, good point. So eligible properties, you can do single family homes, condos, and townhomes. The condo just has to be approved by by MHFA. Again, I'd mentioned you can do a duplex, you can do a modular home. You know what a modular home is?
No,
Where
please.
they basically will put manufactured in 2 or 3 parts and then bring it to the site and put it together.
Okay.
And then on top of a foundation they poured.
Gotcha.
Community land trusts, those are few and far between. There'll be a situation where there's a house in the land trust, and so you're not really buying the land, you're just buying the house, so it's cheaper. The house it's a lot cheaper to buy it that way, because you never really own the land. Some of the difficulties with that one is when you sell it, you have to sell it to someone who's using the same land trust program. And then manufactured homes that are taxed as real property. So like a double wide that's on a foundation type of thing. Did I go too far? No. All right. So as part of the recap, the loans range from $11,000 to $17,000. They're not grants, as we had mentioned. You got to pay them back in full. So the deferred loan option ones you pay back when you sell the house, and then the $17,000 monthly payment one, you're making payments for 10 years on it. And as you know, they all have eligibility requirements of their own, and they can only be used for a house that's purchased in the state of Minnesota.
I have a question for you. Is there a way to pay those early?
Yes.
Without penalty?
Yes, both
You
of
know,
them.
either the startup or the startup.
Yep, so you can pay them off at any time.
Okay.
In fact, I think they prefer you to pay it off quicker than not. So there's minimum credit scores on these programs, and they vary based off of which one you do. So conventional's minimum credit score is 640. FHA breaks it out and says 650 and 660 based off your debt to income, which I'll go over in a sec. And then rural development 640 and 660. So the debt to income is what is your mortgage payment plus all the debt you have compared to your gross income. So they'll go up to 50% of your gross income between your mortgage payment and your debt. And then FHA says, well, if you're at 650, we're only going to go to 45. But if you're over 660, they'll go to 50. And same on the 640 and the 660 with RD. Does that make sense? What happens here, though, is that on the conventional at 640, at 50%, when I take a loan application, we enter everything in the computer, and there's an online underwriting system that we use, and they have to kick it back and say you're approved or not. It's kind of hard to get a 640 approved on a conventional loan at a 50% ratio. It usually turns it down. But if you're on FHA at 660 with 50, that will take it. It'll go through. So that's an example where you might go FHA instead of conventional. And this is like a recap of the 3 down payment closing cost options that we went through. Do you have any questions on the MHFA? It all makes sense? So now we'll look at Wisconsin, because Wisconsin has a similar program. They call it WIIDA, which is the Wisconsin Housing Economic Development Agency. And you have to be a first-time homebuyer to use their program, which is the same definition as someone who hasn't owned a home in the last 3 years. And the income limits are a little more complicated, or more, I don't know if it's more complicated, but they're determined by the county you buy in. So MHFA had more statewide and broke it out a little bit. This one's county to county, and we're figuring out what the income limit is for that. This county right here, like St. Croix County, is one of the higher ones for qualifying. They also have a minimum credit score. It's 620 for conventional and 640 for FHA. They go to 620 on conventional, but I don't think that's gonna get approved. Depends on your scenario, I guess, but they do offer that. And then they also have sale price limits. They're a little bit lower than Minnesota's. So it has non-targeted and targeted. Everything here in Wisconsin, our area is gonna be a non-targeted. Targeted is gonna be more of a lower income area, probably like in Milwaukee or something like that. So they have two different down payment options. The first one, you can receive up to 3% of the loan amount, or $3,050 on a conventional loan. And that's basically because it matches up with the 3% down conventional loan. And you can also get 3.5% or $3,050, the greater of, on an FHA loan. And again, that matches up with the FHA down payment. And the loan goes towards down payment and closing costs. It has the same thing, no interest, no payments. You just have to pay that back when you sell. The other option, they'll give you up to 6% of the loan amount in conventional or FHA. And it's the same thing, a 10-year loan at the same rate as the first. And so if you calculate that based off of the sale price limit I showed before, the 311, on the first one where you get 3% or 3.5%, you get a little bit less than MHFA's offering. But on this one, you can get a little bit more. This one's more like 18,000 on that 311 that they'll give you. So rural development, I had mentioned that before. If you buy in a rural area, they have a 0 down payment loan. You don't have to be a first-time home buyer. The household income cannot exceed 100% of the median income in that county that you're looking in. So again, they go by county as well. And the maximum loan amount is determined by your county. And again, it has to be in an eligible area. So the reason why I bring this one up is because pretty much all of western Wisconsin here, except for a pocket of Hudson, is considered to be in a rural area. So do you know where Lake Malibu is, right in North Hudson there?
Yep.
Like right outside? Anything north of that is considered rural. And if you go east of Carmichael and south of 94, that's rural. And east of Carmichael, and then if you go north, it's a little bit more out to like 35 or so. So it's not that far out of Hudson where you can actually use this program. So they have a website, so if you go in and you just type in the address, it will tell you if it qualifies for the rural development program. And this program is just designed to help rural areas make home ownership a reality. Any questions on that one? So who you work with does matter. And I've worked with these guys for years, especially, Laurie and Stephanie and Jacob and these guys, and I help Chantel with her loan. And they're all incredible agents, not only individually, but as a group. And when it comes to, like we were talking a little bit about, an FHA loan is hard to get accepted versus a conventional. You really need a quality agent working with you at that time who knows how to work that with the listing agent, how to present that offer to make it go through. And so with that, I'm going to turn it back over to Laurie.
So we're going to talk about, now that you have the money, or you think you have the money, or you're working on getting the money, what is that process? And so the first thing you need to do is save for your down payment. We've talked about this, whether it's $1,000 because you qualify for one of the programs, or you need more than that, so you start like pocketing that money away and getting that. Dave's really good at letting you know that. Like he said on that one sheet, you know that the minimum if you go conventional is 3% or 3.5 FHA of the purchase price. So that's easy math. You add some stuff on there for closing costs. Back before it was a seller's market, we were able to ask for closing costs to help you out even more. That's not the case right now. There's a few times maybe, but we know when those times are. But just so you know, it's an option. You might not always be in this market. It's something we can talk about. Then next, you need to know your credit score. If you don't know your credit score, this is something Dave can help you with. and you need to get it up to those 620, 640s so you can qualify. If that's the case, if you're not there yet, talk to Dave. It doesn't mean paying off all your loans and credit cards. Sometimes that hurts you more than it helps you. There's ways to get your credit score, sometimes up in a short matter of time.
Yes.
So
There is a program that if I run your credit and we need to get that score up a little bit, I can send it to the credit bureau and they'll go through your credit report and they'll kick back to me what you need to do to get the score to that point. Sometimes it's just paying a credit card down $500 or $750 or something like that. Yeah.
Yep. So you definitely should talk to him no matter what situation you're in. And then you need to find a qualified real estate agent to work with, but we're gonna fly right by this one because you have a room full of them here and they're all amazing. They're just gonna move right on, and then you come back. You've already had your down payment saved up, you know your credit score, you've worked on that. It's time to get pre-approved. And Dave, you can go right to his website and you can go and it's online and you can figure it out, and then he asks you for a bunch of paperwork to prove that what you said is true, and then you're pre-approved. This is a really, really important step right here. I can't tell you how important this is. Basically, let's just say, like, emotionally how important it is. You think you qualify for something. If you are overestimating, we're gonna start showing you homes that you don't qualify for. When you figure that out, you're gonna be really disappointed. We're gonna be disappointed for you. Everyone's bummed out. On the other end of the spectrum, if you think, oh, I think I can only qualify for this, we're going to show you homes at that level. They might need more work, or maybe they're a little smaller than you need right now, and you're going to have to, upsize eventually. Where if we could have inched you up a little better, you could be in that home longer. You could build more equity over time. So this is super important, especially in today's world. We need you pre-approved. There's just no way around that. Again, there's your guy right there.
I have a question about pre-approval. How long is that valid for?
Right.
Because especially in this market, I mean, I've heard so many people, they're putting in all these offers and getting them denied because somebody else outbid.
Right, I get that question a lot. So basically, when I run your credit report, that's good for 4 months.
Okay.
And I'll get pay stubs and W-2s and things from you. So if nothing really changes, it's good ongoing. It's just every 4 months I have to rerun your credit to make sure nothing's changed on that. Does that make sense? Yeah.
Good question. Next, we're going to find a home. This is the fun part. It can be a frustrating part too, but it is fun. And we're going to start and we're going to go look at homes. In today's market, we used to, I keep saying today's market, but I mean, it's 2022. We've been through a crazy couple of years. There was a time back in the day where we could decide we're going to go out on Saturday and look at 5, 6, 7 homes. And it was fun. You would hop in our car with us. We'd have water for you. We'd stop for coffee part of the day. We'd just go look at homes. That is not the case anymore. If a home comes on the market, we go see it the day it comes on the market. You have a half an hour, sometimes a little more, but let's say a half an hour. Sometimes we're limited to that. You have to decide if you like that home or not enough to make an offer. That's why that pre-approval is so important. That is why working with us as agents is so important, because we are walking through that home like we look at everything. We look at the utility room. We look at things that this is really nice, drapes and blinds, and I love the way the kitchen looks. We're looking under the sink. We're opening the fridge. We're doing a lot more in the time we have. It's important. Because the next step then is to make an offer. So you've been in a home for 30 minutes, and you have to decide. You don't do anything. It takes a day and a half to buy a new phone, and you have 30 minutes to buy a house. So this is really important. Again, who you work with, having Dave. Dave is invaluable in this point because he actually calls up the listing agent and vouches for you. So when we write an offer, we have a pre-approval letter from him saying, yes, they're approved to buy this house, they're golden. He actually calls the listing agent. This has made the difference in us getting our clients' offers accepted. Rocket Mortgage doesn't call. What's the other one? Quicken Loans.
Yeah.
We can't even call them.
Right.
There's no one there. So that's important. We make the offer. There's a few other things we can do in an offer in today's world to kind of, you might not be the highest. We've had success getting our clients' offer accepted when we're not the highest. We were the best, and that's why. One of the things about that is the home inspection. And I don't know if you guys have heard lately, there are people not having inspections and buying homes, which seems insane. And sometimes it's what we need to do. Again, we walk in the home with you, we're looking at everything we've done. Stephanie and I, and Chantel, she's redoing it. She knows what wall you can take out and not take out because she's done it. Jacob has done his rehabbing. If we walk into a home and there's some red flags, no matter how badly you want that home, we're gonna say, I would not buy this home without an inspection. There's just some things we're just not gonna let fly. There's other homes we've walked into where we're like, we've looked at all the major stuff. We know the history of this home. It's a calculated risk, but it's one worth taking. So that's something to think about, but most of the time we prefer you get an inspection. You pay for that out of pocket at the time of inspection, somewhere between $300 and $400 or $500, depending on the size of the home and what they're inspecting. We just inspect the home. They check the outlets, the windows, the furnace, whatever. We septic and well, for those of you who live, like if you're doing rural or you're out a little, that's on the seller. That's finally one thing a seller has to pay for these days. Next, after we get through the inspection period, you do an appraisal. This is a requirement of the lender, not us, not you. Even though this little slide says worth the price you're prepared to pay, I should cross it out, that's not it. The lender wants to know it's worth the money they're borrowing you. That's it. So they want to know. Again, back to conventional, because your credit score is a little higher, you're putting a little more down, they think you know what you're doing. They don't care if the railing's wobbly, whatever, they don't care. They want to know that it's just worth the value. FHA is different. They want to know it's worth the value and there's no safety risks to you. You're not going to fall down the stairs because you cut your sleeve on a railing that wasn't tight or something like that. So they're going to require some work, and that's the difference in there. VA, if we have anyone who's military or eligible for military benefits, they're the same as FHA. They're really careful with that stuff. After that, you close. This is the day you go to the title company, and we used to sit across from the sellers and talk about what day was garbage, what the neighbors were like, which ones not to talk to, which ones you should talk to, all that good stuff. We don't do that anymore since COVID. Maybe we'll end up doing that again someday. Right now, it's just you and me or you and your agent at the table signing away everything. You bring your money, either you wire it or you bring a certified check at that point. It's a lot of papers. It's a lot. And then you sign, you give them your money, you get the keys, the garage door opener, the code to the garage, all the good stuff. And ta-da, you get to move in, and now you're building equity, and you get to do whatever you want to your house because it's yours. You can paint the walls any color you want. You can, take walls out if you want, everything you need. So that is the process, really quickly, really high level. We have folders here for you guys. It includes some of this. It includes a worksheet of your needs, wants, and wishes because, especially if you're buying with someone else, you want to make sure you're kind of on the same page. It's very rare that people are on the same page on everything. So what are the things that you are willing to compromise and not? We also have some information from Dave in there on the MHFA program. We also are going to put this on our website. So if you need a recap, you can do that. We're willing to send you even more information. So make sure that agent who invited you has your email so you can get all of that information you need because we went through this pretty quickly, I think.
Yeah.
But if there's any questions about anything that was asked along the way, because we did go fast, we just wanted to give you a quick overview and let you know that there are ways to get you into a home. So, any questions? Katie?
I was wondering if the MHFA requires mortgage insurance, if that program requires it.
It does. So on the conventional and that, they all do. So yeah, they do require mortgage insurance if you have less than 20% down. I've had people actually have some cash in the bank and then use the down payment assistance to get the 20%. You can do that too.
So back to the mortgage insurance, and I was only half listening, I'm sorry, but I kind of heard it before. But the other thing is, and you may have mentioned it, on conventional, once you get to 20%, you can, it doesn't just happen automatically. You need to make sure your home is at that level or you paid off that much. You can get rid of that mortgage insurance and keep the same loan, same interest rate,
Right.
same loan.
Yep.
FHA, they changed this 4 or 5 years ago, right? You can't get rid of it at 20% unless you refinance, which might matter when in today's world we were at 3% and now 4%, but I mean there were times where rates were in the double digits. So you know, if rates keep going up and 5 years from now you're at 20%, but the rates are at 6 or 7, it's not worth it for you.
Right.
Just keep the MIP,
Yeah,
right?
right.
So that's why if we can, we try to get you to conventional. That's another, so that's kind of 2 reasons.
Yeah.
Anything else?
What's the importance of a buyer's agent?
Super important. Thank you for asking. The importance of a buyer's agent is the reasons that we talked about. Is we're going to help you, first of all, make sure you're qualified. You're working with a qualified lender. That's important. We, as listing agents, we know what comes across our desk and the ones we toss out, even if they're higher money. The other thing is to walk you through homes. We have a knowledge of not only the homes themselves, but the areas you're buying in. This is really important. And we also are able to negotiate. Something I can say about everyone on our team, we not only are good at what we do, we have a really good reputation across the industry with other agents. And Chantel and I were just talking about this the other day. There are times when we've called up listing agents, because of our reputation, they've given us more information, they've given other agents like, hey, this is what we're looking for, and they get very specific. They've also given us kind of, I wouldn't say the benefit of the doubt, they've kind of given us like first seat, right, at the table, where they've said, we know you, we know how you work, we know you're gonna get it to close, we trust you, we'd rather work with you. It matters a lot. Thank you. Thanks for that. Anything else?
Next question, what makes an offer more attractive in today's market?
So right now, we are at about what, 10% over?
Over what?
Asking, average?
Oh, yeah, yep, I'd say.
So if you're at 200, a house at 200, if you can find a house at 200, you know, you're gonna probably have to go to 220 or higher. Now think as that goes up. So what can we do if you're just not able to go as high as we think the house is gonna go? One thing is the inspection. But again, we're gonna be really careful about that. Another thing we can do is the move-in date. We're gonna be really careful about this. So the sellers are there, they have to sell to buy. The way it works, it's Crazyville. They have to have everything packed and get out of the house for the closing on the house they're selling. The moving truck just drives in circles or goes to lunch. And then they close on the house they're buying, and then they get to move in. It's expensive and it's stressful. I mean, there's no way around it. Sometimes, depending on what we know, we can say, we will close in the morning and give you 24 hours or 48 hours or whatever before you have to move out. They just go, this is amazing. It's gonna save them money, it's gonna save them stress. There's a risk there, because let's say they bounce the couch down the hallway as they move out, right? You are now the owner of that house. So we have to be careful. And again, that is when the agent has relationships with the other agent, and we kind of suss that out. We don't make that. There's also ways to guarantee the appraisal gap. Again, this depends on funds and where you're getting them from. If the appraisal comes in at, you offered $295 and the appraisal comes in at $290, that's a $5,000 gap. Well, in a normal world, the seller just comes down to that's what the house is worth. What we can do is say, we'll guarantee up to $5,000, or we'll guarantee a certain number over appraised value. So that gives them a little comfort. So there's a few things, there's a few tricks we have up our sleeve. Anyone else?
I have a question regarding, if two individuals who are not married are purchasing a home together, how does that go with the credit score? If you have somebody that has a really strong credit score versus the other person that might not, I mean, do they combine them and look at it, or how does that work?
What they do now is they take the lesser, so you each get 3 scores, and they'll look at the middle score for each, and they'll take the lower of the two of you.
So it's gonna be that
There is,
person.
yeah, there is some talk right now, and the investors haven't done this yet, is doing like an average, which would, if someone's really strong and someone's low, then it brings you up. So in our application system, they actually added that a couple months ago, so I've seen it now when I enter an app, but they haven't incorporated that yet, but I think that's to come.
Okay.
Yeah.
And so that brings up the question, you could just use one person to
Right.
buy if you qualify
Sure.
income-wise. The other person could help with the down payment, right?
Yep.
So they could provide the down payment if they had the money and you have the credit score or whatever, because we had that with like a mother-daughter situation.
I have that going right now with someone else, where I just took one person off the app because I didn't need their income. And on a conventional loan, you're not doing the first-time home buyer, your rate's based off your credit score too. So they'll get a better interest rate if we just take the lower person off.
But then legally, it's the one person who owns the home,
No,
correct?
nope.
Oh,
You both can be on the
still be
You'll both
deed.
be on title.
can both
Yep,
be
on
the
title,
deed. Okay.
but only one's on the mortgage.
Okay, wow.
So you better trust
Okay.
that
Yeah, I was just
person.
gonna say. That's a little dicey.
Yeah. The other thing, just so you know, if you're thinking, if you buy a house while you're single and you get married, to sell the house, both people have to sign. So don't get divorced before you sell the house. So single, married, stay married, sell the house, and then do what you want to do. That's it. Anything else? Any other questions? I think these are good questions.
Yeah.
They're good for us too. All right. Well, oh, Hannah. Hannah's like,
Can I use the FHA program to like invest in a house and rent it out, or do I have to live in that house?
You have to own or occupy it. So you have to live in the house, yep.
but
So, but,
what about, like, you could buy a duplex?
yeah, I was gonna say, so if you buy a duplex, you have to live in one half of the duplex. And one of the differences from what we talked about on the duplex is you can do a 5% down duplex, so you have to put at least 5% down. You have to use that step-up program, which is the one with the payment on it. And you have to have at least 3% of your own money versus $1,000 into the deal. And then also you do a first-time homebuyer education course. You also have to do like a landlord education course too. So you have to do 2 courses for that. But if you go try to get a duplex on a conventional loan outside of this program, you have to put at least 15% down. So that 5% down is a big difference. Big advantage.
And Jacob on our team, that's what he did. He was
Yep.
the down payment assistant, did the coursework. So if anyone is thinking about that, we have someone who very recently went through that whole process and can kind of be a resource that way.
I like that they have those requirements. I just think that's good to
Yeah.
go through that
Yeah.
information.
It's a good course, whether you're a first-time home buyer or not.
It
I
is,
mean,
it's a real
'cause
good course.
we have people who have lived in their homes forever and now are going to go buy for the first time in 20, 30 years. I mean, it's a whole different world now.
Right.
All right. Well, unless someone has something else, we still have plenty of beer and wine and snacks. And if you have any questions for us aside, if there's something very specific to your situation, talk to your agent, talk to Dave, and that's it. Thank you, everybody.
Yay.